I think what we're going to do is go ahead and begin. And as
Sure.
others join, we will just add them along. Everyone, my name is June Younger, and I'm the Chamber Coordinator here at the Commerce City Chamber of Commerce. And I want to thank everyone for coming out today. As I was telling everyone prior, since we are on the free version of Zoom right now, until we can get it approved to go to a paid version through our board, we're using the free version. So I have set this meeting up into 2 separate meetings because after about 40 minutes, they like drop you off. So I sent you both invitations, and one is for this meeting, and then the second one you can use the meeting ID and the password. So they're both unique so that we keep security for our meetings, and I know exactly I can control who is here. I just don't want us to be Zoom bombed like some of the other places have been. So we can go around if you want, but you know what? It's already 10 after, so I think what we'll do is we're going to start off with our presenter today. Lynn King is the Corporate Vice President of Advanced Planning Group for New York Life Insurance, and she's going to be talking to us about the CARES Act as well as the Secure Act. And I just want to give you ample time, Lynn, so that you can do your presentation. If you have a question, feel free, any of the participants, to, either
just jump in.
just jump in. And so that, we can, get your questions answered, because that's what this whole thing is about, is so that everyone has, the information that they need to move forward. So Lynn, why don't you go ahead and take it away?
Perfect. Thank you so much. And I will go ahead and share my screen here with everybody. All right. And I'm actually going to stop my video because I have 2 screens, and then I just end up kind of looking, off to the side. So it's just, I find it odd, but my name is Lynn King. I am an advanced planning consultant for New York Life. Our group is comprised of attorneys and CPAs that are here to support our advisors. And a lot of what we do is education, especially now with the way things are changing so quickly. At the beginning of this year, the Secure Act, so not the CARES Act, I'll get there in a second, but the Secure Act was passed. And the Secure Act was actually a big change to retirement funds, how those are passed on to our heirs, RMDs, required minimum distributions. Those rules changed for beneficiaries of IRAs. And there are some other changes that relate to, retirement planning inside 401ks. So I'll go a little bit into that, I think, once we switch over to the second room. We do have a great national seminar coming up next week on Tuesday that dives really deep into the Secure Act. So I'll make sure you all get an invite. It's through one of the nationally known leaders on retirement planning. So I definitely want to make sure you guys get that information as well. But today I want to go through the CARES Act because obviously with the Chamber of Commerce, this is probably on the forefront of a lot of your minds. I know it's on the forefront of a lot of advisors I work with, of course, their clients. And so this law was signed into effect on March 27th, 2020. So just about a month ago. And obviously this was in response to the coronavirus epidemic, and it was really meant to provide emergency medical funding support, paid sick leave for employees. And really it's desperate times call for desperate measures, and the sudden and immediate shutdown of a large swath of the US and really globally as a result of COVID-19 has really resulted in a surge of unemployed workers. Obviously, businesses facing a lot of different concerns coming from a lot of different angles. And the government mandated closures really dictated a needed government response. And this government response includes direct cash payments to many businesses, as well as government secured loans, payments directly to families. And there's a lot in this legislation, so we'll jump right in, because I want to make sure we have enough time to get through the parts that I think are going to be most important for you guys. And so the biggest things that really happened as a part of this law, the key provisions, are obviously these expedited small business loans. And I know there's been a lot in the media about how it's been difficult. Obviously the first round of funding ran out of money, so a second round of funding came in. These are all loans that are backed by or secured by the Small Business Administration and the federal government. It provides businesses with less than 500 employees up to $10 million. And all of that would be forgivable because it's supposed to cover 8 weeks of payroll, rent, mortgage interest, and utilities. So we'll go through the application process, save for the fact that there is overwhelming demand. Applying for it, the information you need to provide is not that difficult. It's the loan forgiveness side that's going to require a lot more documentation. Also, there's going to be payments, and a lot of people received these payments to families, $1,200 per individual plus $500 per child. But we'll go through some ways that maybe people who didn't qualify could maybe qualify this year and still end up getting those payments. You can take a penalty-free withdrawal from your IRA or loan from your IRA for $100,000 if you have been impacted by coronavirus. Impacted means you've had it, you're caring for someone that's had it, or because of the shutdowns, you have been adversely financially impacted. You can't go to work, you don't have childcare. We'll go through some of that. I think everybody on this call today could say that they have definitely been financially affected by the coronavirus, but there are some requirements there. The penalty-free access is great because if you're under 59 and a half, typically when you want to access your IRA, you have to pay a 10% penalty on top of all of the taxes that you have to pay to access that IRA. So it can be a pretty big tax loss. So to waive that is a big deal. There's a waiver of required minimum distributions from IRAs in 2020. Because of the market crash, the government didn't want people having to dip into their IRAs necessarily to pull out these required minimum distributions. They wanted people letting their money work on the upswing. There's also deferral for payment of the employer portion of FICA taxes in 2020. So there is a deferral for that. And what I think is actually really cool, and this is something that I think is going to help a lot of businesses, is this net operating loss carryback to private tax or previous tax years. So you can carry back losses that you incurred in 18, 19, or 2020 back up to the prior 5 tax years to get a potential tax refund this year and next year. So for businesses that were operating, very successful, making money, showing lots of profits, paid a lot of taxes last year, this year potentially because of the coronavirus outbreak and other things going on in the economy are now going to show losses. They can actually apply those losses against previous tax years and get refunds. And so this is going to be something that's going to keep CPAs very, very busy. And then there's some small changes to charitable gifts, educational expenses, and things like that. So the Paycheck Protection Program loan, this is the one through the Small Business Administration. It's intended to assist companies that are in need of funds to keep employees on the payroll because of the economic shutdown. So borrowers that are getting these loans have to certify that the current economic conditions make it necessary for the loan to support ongoing operations. The funds are going to be used to retain workers and maintain payroll, make mortgage expenses, lease payments, or utility payments. And the lending institution themselves are being given the authority to verify the purpose and suitability of the loans. And so the SBA's provided some guidance on this. This was one of the biggest things in the beginning that banks were worried about, is if they don't certify correctly, is there going to be a problem when these banks, go looking to the SBA and the federal government who's backing these loans to pay them and pay for that forgiveness. So But SBA came out, they said, it's not, you don't have to show immediate and specific financial distress, just that you've been impacted and certify you need the loan to keep people paid and keep people on the payroll. And these loans do not require personal guarantees, and they're considered non-recourse to the business owner as long as the loan is used for payroll, rent, utilities, something like that. So if a business takes out one of these loans and then unfortunately still can't make things work, and a few months from now the business goes under, they potentially have to file bankruptcy, the bank cannot come after that business owner to recoup the costs of this loan. That's something that was really important in this legislation, was they didn't want business owners not taking the loan for fear that they might be caught having to personally pledge assets to pay it back. So the most significant and desperately needed program to be established under the law involved the ability for businesses with fewer than 500 employees to get this $10 million paycheck. So, or up to a $10 million paycheck to pay their employees. So not only is there an immediate infusion of capital being made available to hundreds of thousands of small businesses, but also a portion of the amount borrowed can be forgiven as an effective grant on the cost of payroll and certain business expenses. So it is fewer than 500 employees to qualify. However, in addition to traditional businesses that are under the SBA's guidelines, it's really now any business concern, nonprofit organization, veterans organization, or tribal business. And even though they say no more than 500 employees, there are some accommodations, and I know you guys have probably heard about these. I think Ruth's Chris is the one that everyone talks about the most, Potbellies. If you have fewer than 500 employees per location and you are a accommodation or food business, you can judge this $500 or 500 limit on employees per location. And that's how these large companies were actually able to get these loans. Luckily, a lot of these companies are returning them because they really don't need them. And so that money is hopefully a lot of it going to go back and go to the true small businesses that need this. Now, this 500 employees per location rule does not apply to amusement parks, theaters, recreation, or entertainment facilities. So, AMC Theaters isn't going to get this, but perhaps a franchisee of Hilton Hotels would. So just a few little differences in there. Also, which is a little bit different, is the 500 employee rule includes all employees, full-time, part-time, all employees. And this also extends to sole proprietors and independent contractors. So this is something very different than what we would typically see through the SBA loan. It applies to gig workers, the Lyft drivers, the Uber drivers, the Instacart shoppers. This is not something you would typically see the SBA get involved in. And that, that business, there's also another loan program that's called the Economic Injury Disaster Loan. So businesses that apply for this Economic Injury Disaster Loan, which is a true loan program through the SBA, are still eligible for this Paycheck Protection Loan, as long as that Economic Injury Disaster Loan is used for separate purposes. And so the PPP loan, again, is for payroll, rent, utilities, but there are other expenses businesses might have. And if they need money for that, they would apply for that Economic Injury Disaster Loan. And that could cover things like if you were in the middle of a remodel, for instance, on your business and this hit, you need to finish that remodel. It could be buying equipment or helping pay loans on equipment, things that PPP wouldn't cover, but are still very real expenses for employees. So the businesses that don't necessarily need funds to operate, this law is really intended to assist companies that are in need of funds. So that's why, again, you have to certify that you need these funds to operate. If they somehow conclude later on that you don't, it's likely this loan would not be forgiven. So again, the maximum loan that a company can get is $10 million. The loan amount that each company can get is 2.5 times average monthly payroll costs. And so that means you look at payroll over the last 12 months. Add it all together, divide by 12 times 2.5. That's what you're looking at as far as what you can take out. Seasonal employers, where they don't have even employment across all year or across all of the year, would look at a 12-week period beginning either in February, March, or June. And then new employers look at their payroll that they paid from January 1 of 2020 to December or February 29th of 2020. It's a typo, not 2029. So just calculating this very quickly, anyone that makes over $100,000 in payroll is capped. And so if you have a business that maybe, and this includes the owner's salary too. So if you have an owner that made $200,000 in W-2 wages, we would have to reduce their salary to 100 because no employee compensation over 100,000 is considered in this calculation. But let's say no one in the company made over 100,000. You had 2 million of payroll divided by 12 months is 166,000 of average monthly payroll costs. You can get 2.5 times that, so about 416,000. And that again is used for those payroll, rent, utilities, expenses. So right now, the maximum interest rate on these loans is 1% if it's not forgiven. So whatever's not forgiven, the max rate is 1%. It's a 2-year loan, so you have to pay it back within 2 years. Principal and interest can be deferred for a period of 6 months and up to a year. There's no prepayment penalties. And again, the hope is most of this would be mostly forgiven. Now, what are the forgiveness terms? Because again, this is really where it hits home, and this is where this really starts to be a really good program for business owners, is that the amount that's forgiven is based on the expenditures incurred for the 8-week period beginning on the date of the origination of the loan. So the loan, funded today, April 30th, we would go 8 weeks out, and that's how we would determine the forgiveness period. Now, during that period, anything on payroll costs, interest payments on mortgages or on real property or personal property would also be eligible as long as that mortgage was enforced before December or February 15th of 2020. This includes utility payments and rental payments. Those contracts, those utilities, they all have to have been set up before February 15th. So unfortunately, if you had a business that opened up the last week of February, they could not use this loan to cover rent and utilities, which is unfortunate, but there's probably not too many people in that situation. Obviously, the total amount forgiven can't exceed the amount borrowed, go figure. But the amount of forgiveness, and this is really important, is based on the extent that employees are maintained on the payroll in the business. And so any reduction in workforce is going to reduce how much is forgiven. Because remember, we determined how much you get based on who was employed last year. So if you reduce your workforce substantially, then you don't necessarily get that full forgiveness. Also, if you reduce salary for employees, the forgiveness would be likewise reduced as well. So the amount of the forgiveness on this wage reduction, you would have a loan forgiveness reduction based on any salary that was cut more than 25%. And this is actually really interesting. The loan principal that's forgiven is not included in income. And so essentially, anytime you have a loan, and traditional IRS rules say if I loan someone money and then I forgive that loan, it's like I paid them income and I have to pay tax on that income. That is not what we see with this PPP program. Any loan forgiveness will not be included in income. And as of right now, it's also looking like the expenses that are paid for by this PPP loan can also still be deducted on taxes. So the federal government is funding the next 8 weeks of payroll. You don't have to pay tax on that money that they give you. And you can still potentially, they may change this, deduct it from your 2020 taxes when you file in 2021. So just as an example, if we do have a workforce reduction, and this is probably going to happen, obviously, you know, even with businesses that want to keep everyone on the payroll, there is a recognition, I think, that when businesses do reopen, especially in the hospitality industry, they're not going to open at 100%. They're going to open at 25% capacity, 50% capacity. So if you took out a $100,000 loan for payroll, we would look at your average monthly full-time employees in January and February, and that would be 22. Let's say you reduced to 18 full-time employees in May, 14 in June. So there was about a 28% reduction in your workforce. Therefore, the total amount forgiven would be reduced to about $72,000. The other $28,000 would have to be repaid because you reduced your workforce, and it had to be repaid 1% interest over the next 2 years. So something important to note there. Also, what are payroll costs? This is something else that's really important. Payroll is not just salary. It's also commissions and cash tips. So for people in the restaurant industry, obviously the salaries are low, but the tips are where they make their money. So those would be included in payroll costs. Payment for leave, family leave, medical or sick leave is included. Payments for group healthcare benefits. This is a big expense for a lot of employers. So the government will come in and help you pay those during this time period. Also, retirement benefits, you know, funding for those retirement programs, the government will come in and help with that as well. And then income and earnings as a self-employed individual, as a sole proprietor or independent contractor. So anyone that is a sole proprietor or independent contractor files a Schedule C with their taxes. That would be what you need to submit with your loan application, not the 1099s, not W-2s if you're a statutory employee, but your Schedule C. That's what they want you to submit. And then there's a maximum payout of $100,000 per employee that's residing in the US. So the maximum benefit you can get for any one employee over that 8-week period is about $1,900 a week. Still, you know, it's not just salary. Keep in mind there are other things, and it is capped though at about $1,900 and $1,923 a week. So now we'll switch a little bit over to the personal side of this legislation, not as focused on the business side, but there's the individual rebates that came out. You can access IRAs and qualified plans potentially on a preferential basis. There was a waiver of RMDs in 2020, and then some miscellaneous provisions with charities and student loan programs. So I know I got a stimulus check. It was a couple of weeks ago. I don't know if you guys got yours or saw it. You know, I was actually surprised, but it's because I hadn't filed my 2019 taxes yet. It was, it's kind of interesting part about this law that I'll get into. But one of the things I like to point out here is this is an advanced tax credit for 2020. So essentially what the government said is we're going to offer a tax credit against 2020 income, but we're going to advance it to you now. And that was what was deposited into your bank accounts, hopefully. You know, the income limits are there. The one thing I get a lot of questions on about this is the dependents, because you do get $500 per dependent under 17. Unfortunately, that does mean that college kids who are usually dependents would not receive a $500 payout. But keep in mind, this is a 2020 advanced tax credit, so it may be worth investigating with your CPA or tax professional. Should your child file their own return in 2020? Because the way they determined eligibility for this was based off of either your 2018 or 2019 return. If you had filed your 2019 return, that's what the income they used. If you hadn't yet, you went off of your 2018 return. Now, some people who have not received this check yet may want to look and say, was my income higher or lower in 2019 as opposed to 2018? If it was higher in 2019, you don't want to file your return yet. You have till June 15th. Use your lower income to potentially qualify for this rebate. And this is a refundable rebate, meaning a taxpayer does not need taxable income in order to be eligible. And so if you do know someone that doesn't really have taxable income, doesn't necessarily file because there just is nothing there to file, they should apply for this rebate because they can still get it. And then for those that who are on Social Security that don't usually file a return, they'll receive a payment. They don't need to file. It should already be there actually. But for those people that maybe were disqualified based on 2019 income, you know, they did well in 2019 as a family, they made over 200,000 as business owners, but unfortunately this year, because of you know, the government shutdowns and everything that comes with it, their income could fall dramatically. And so if that, you know, married couple, their income goes from 250,000 to 100,000, when they file their taxes in 2020, they can still actually get this rebate with their 2020 tax filing. So that's something important to keep in mind, is if you are disqualified because of your 2019 income, but your 2020 income qualifies you, it's still available. And so how does the phase out work? So if you have a couple with 2 kids, $2,400 is the rebate for the couple. The rebate for each of their dependents is $1,000. So the max they could get was $3,400. But the threshold for a married couple is $150,000. If you make over that, you're reduced your rebate is reduced by 5% of your AGI over that threshold. So for this couple, it was $30,000. 5% of that is $1,500. So their rebate would be about $1,900. So if you feel there is an error in how yours was calculated, or if you received a partial rebate this year, but maybe you can get more when you file your 2020 return, you know, that's only serves you to kind of take a look and see where you're at. So this is actually going to be something too, this preferential access to IRAs, that could really help business owners that are in trouble. So individuals who have been adversely impacted by COVID-19, they have the ability during 2020 to take a penalty-free distribution of up to $100,000 from retirement accounts and defined contribution plans. So this doesn't include pension plans or things like that. This is really IRAs, potentially 401ks if an employer allows in-service distributions, and defined contribution plans. If you are currently employed or you know, you have a 401k for your business, it is very common that there are no in-service distributions. So while you're still working, you can't take a distribution, you can only take a loan. So a loan is still available. You can get a loan of up to $100,000. Or if you want to withdraw, I know there are a lot of plan administrators changing the rules and saying we will allow for some in-service distributions. So that's nice. But basically, if you take out this $100,000 from your IRA, you have a 3-year period to either recontribute that money to your IRA or pay the income taxes on it. And there would be no tax withholding for the money coming out of that IRA. So typically when you pull money out of your IRA, there's a 20% withholding. They're not going to do that with this money, and you have to pay all of the income on it in 1 year. Again, under this new provision, you have 3 years to spread out that income. I would say with low tax rates being low right now, with the need for cash never being higher, this is a great way for business owners to just immediately get some cash in their hands. And you don't have to repay, if you want to treat it as a loan from the IRA, not a withdrawal, you can delay those repayments for up to a year. So there's a lot of opportunity there. And I think this is something that people just need to know a little bit more about. But again, you have to be adversely impacted by COVID-19. So what does that mean again? You have to be diagnosed with it, have a spouse or dependent diagnosed with it, or experience adverse financial consequence as a result of quarantine, furlough, being laid off, a reduction in work hours, or an inability to work due to lack of childcare, business closings, or reduced hours. Again, anyone that owns a business is affected by COVID-19, I would presume. But again, check with your tax professional on that. So, and any withdrawals from this IRA can be included in your income over the next 3-year period. So you don't have to claim all the income in this year, or you can choose to pay it back. You can do a wait and see provision. So miscellaneous things, RMDs are waived for 2020. You do not have to take required minimum distributions, and this also includes inherited IRAs. So if you have an inherited IRA, you do not have to take the RMDs. The charitable income tax deduction, you can now deduct up to 100% of your income if you do want to contribute it to charity. This is up from 60%. And then anyone that donates $300 or more to a charity this year will get an above the line deduction for that. So essentially just prompting people to make those donations to charitable organizations that really do need help right now. The IRS will come in at the end of the year and give you a $300 above the line deduction for that. And then any employers that repay student loans for students, that loan repayment used to be treated as income for students. It is not going to be this year. And payments on most federally backed student loans are suspended until the end of September, and no interest is going to accrue on those. So there's a lot buried in this legislation, obviously. We do have, and I will send around to everybody, we do have, I think it's like 8-9 pages, but we call it the Eye on Congress, and it is a explanation of all of this. Very, set up very well. You guys can send this out to anybody you would like if you think they could get, some use out of it. Obviously, SBA.gov has a ton of information, and state and local governments are all doing a lot of different things as well.
But I do have a quick question. I have a couple of questions, actually. For those who are on Social Security, because my parents are, they had not received their stimulus. So what, do we just continue to wait? Do we contact, is it going through the states or federal?
It's going through federal, so you'd want to go to, I believe the Treasury Department website is the one that is handling that, not the IRS at this point. And there is a way to request your check if you haven't received it yet. Although I have heard rumors, and this is just rumors, not anything beyond that, that the Social Security recipients, those are moving a little bit slower, unfortunately. But I would go, onto the Treasury Department website, and you can request where you want the check sent. Also, it depends on if they were getting Social Security direct deposited or not.
Okay. Yeah, they were. So.
Yeah. So they should have. But again, I have heard rumors those Social Security recipients are being delayed a little bit more. At least that's the rumor on the street.
Okay. Another question was the educational. I have one of those college kids. That's
yeah.
That loop, because we do claim him. This is going to be our last year that we can claim him as a dependent. However, he also files his own taxes because he works, but he didn't receive anything either way.
Yeah, because you claimed him as a dependent. He would not. Now, you guys might want to look and see, does it make sense for you not to claim him as a dependent? And it really is a math exercise of, if you guys don't claim him, would that, yield more money for your family overall? And so that's where CPAs are going to be busy this year, along with a lot of these other tax changes. So it's depending on how much he earns, and all of that would probably give you that answer.
And Lynn, you said if they are receiving Social Security and they didn't file taxes, that they can still request it?
Yep. Yeah, you don't have to have any taxable income to get this. And Social Security recipients were automatically put into the bucket of we're going to send it out, but I do think I have heard there's been delays with that. So just from clients I've talked to. So any other questions? Okay. So what I can do is I will share my screen again. Hopefully I can get this working. I do not have another fun PowerPoint. I know, so sad. But I do want to go over some key provisions of the Secure Act with you guys. This came into effect January 1. And so really the biggest thing that the Secure Act did is for those of us that are going to inherit qualified plans from our parents, those of us who are thinking of leaving qualified plans to our kids. It used to be that if my mother passed away, I would inherit her IRA, and I used to be able to stretch the distributions I had to take over my lifetime. So instead of jumping in and me treating or being treated like her, or potentially having to withdraw it all within 5 years, there was always this option that if you had an individual designated beneficiary, a person that was your beneficiary, they would only be required to take out as much every year as based on their own life expectancy. Now, that result, of course, was a child who is 50 years old, 40 years old, when they inherit their parents' IRA, that IRA might have, $800,000 in it. Because my life expectancy is much longer than someone in their 70s or 80s, I might only have to take out $20,000, $25,000 a year for quite some time. It prevented me from having a big tax bill, essentially, because most people are at their highest wage earning years between 40 and 60 years old. That's when most people inherit these IRAs. So that stretch IRA was a really, really nice tax planning tool. And like any really nice tax planning tool, the IRS will take it away. So what this did was, as of January 1, anyone that passes away on January 1 or after 2020 will no longer be able to stretch the IRA. And so when you inherit an IRA now as an individual, and there are a few caveats to this, but for most people, they will be required to pull the entire balance of that IRA out within 10 years. And so if you think about this in terms of tax efficiency and tax planning, it's going to have a big impact on beneficiaries of IRAs. And one of the biggest impacts is, again, if I inherit my mother's IRA with $800,000 in it, I'm at my highest wage earning years, at 50 years old, then I have to take another $80,000 of income into, my pocket, which, is $80,000, but you still got to pay taxes on it. It's going to bump you up into a higher tax rate. And IRAs usually include some enhanced asset protection as well. You lose that when it goes into your own personal bank account. But the 10-year rule was really created so that the IRS could get more tax money more quickly. They didn't want to wait over the course of 30, 40 years for these inherited IRAs to get all of the taxes. IRS wants their money. They want it now. They changed the tax code, so that's what we're doing. It's a 10-year rule now. All the money has to be out within 10 years. For those of you that have a trust named as a beneficiary of your IRAs, it would be a good idea to look at that trust with your attorney. Because of the way most trusts are drafted, you could end up in a situation where after you're gone, the trust would not be allowed to take anything from the IRA from years 1 through 9, but in year 10 would be required to pull it all out. And that could potentially be a big tax hit. So for anyone that has their trust named as beneficiary of their IRAs, it's a good thing to review it with your attorney. Make sure that it's not going to have some unintended consequences. There's still the same rule where if you do have a non-designated beneficiary, a not person, whether it is a charity a non-qualifying trust, things like that. There's 5 years. There's a 5-year rule. So it's either a 5-year rule or a 10-year rule now, which again is just trying to force all this money that's being held in these qualified accounts, force it out into the system, get it taxed, get more money in to the IRS. So who's exempt from this 10-year rule? Well, spouses. So spouses can do a spousal rollover and continue to take money over their lifetime. So those people aren't cut out. Minor children, so they have to be children though, not grandchildren or nieces, nephews, anything like that. So I pass away tomorrow, my kids are 7 and 9. They could still take a small amount of money from the IRA until they are out of college, basically, and then they would have 10 years to get the rest out. And so there still is an accelerated schedule, but they wait until the kids are out of college to put that accelerated schedule into effect. If you have a disabled or chronically ill individual, we're not going to make them take all the money out. This includes special needs trusts as well. And then for beneficiaries who are no more than 10 years younger than the original owner. So let's say my mom left her IRA to her sister, who is 8 years younger. The IRS is like, well, you're close enough in age, so we'll go ahead and let you still stretch it over your lifetime. But this brings up some interesting planning implications when it comes to large IRA balances, large 401k balances. Does it make sense to have your kids inherit this taxable asset, taxable within 10 years? Or does it make more sense to start looking at things like Roth conversions? You know, if you have some room in your tax bracket right now, does it make sense to maybe pull more out of your IRA right now, get it into something that isn't going to be taxed again, so you don't have to worry about dumping potentially tens of thousands of dollars of taxable income into your kids' laps, and they're forced to take it. So they have to take it, or they will suffer the wrath of tax court and penalties, and nobody wants that. But very quickly, just to kind of show you the impact that this has, if we were going to do an immediate distribution of an IRA, so we have $1 million IRA, and it's inherited by a 40-year-old beneficiary. Now, if we assume there was a 6% earnings rate and a 30% tax rate on earnings, what it would look like is if we took all this $1 million out in one lump sum immediately when we inherited it, invested it at 6%, it would grow to about $2.3 million over 30 years after taxes. Now, if we take a lump sum, if we let it sit for 10 years, take a lump sum 10 years after we inherit it, you can see just waiting 10 years and letting that growth stay tax deferred for 10 years, you have an extra $500,000. But if I were to be able to let this all grow tax deferred and just take my RMDs slowly over time, I would have after-tax spendable income of $3.3 million. So losing this tax deferral can be pretty significant, especially when your child is likely going to be in a much higher tax bracket than you are in retirement, because they'll be in their highest wage earning years. So it's something to be aware of. And like I said, we do have someone coming in that is going to do a bigger conversation around, all right, so the laws changed. How does that change financial planning? And Sandra, I think I don't know if you received the link yet for that seminar sign up.
Yes, I did.
Okay, yeah. If you want to send it around, because every advisor has their own special link. So, but these are heavily attended. We did a series of these a couple weeks ago, and there was more demand than we had space for. But they're really, really good, especially if you're approaching retirement or in retirement, or quite frankly, expect to inherit an IRA at some point. Just learning some of the tax efficient ways to do this. So with that, I'd be happy to take some questions on this very exciting topic of, IRAs.
Actually, I don't have any questions, but it's great information.
Good. And I'm happy to send around, I can send the piece around we were just looking at, as well as the one on the CARES Act for you guys, so that way I have a copy.
I have a question, but it's on the first half of the program. When going back, you mentioned that $300 to any charity can be deducted now.
Correct, correct.
Does it have to be specific to one charity, or can it be $100, $100, $100?
Yeah, can be anywhere. You know, any number of organizations. Absolutely.
Okay, thank you.
Sure, no problem. Well, good. It doesn't look like there's any men in this Chamber of Commerce. I love it.
They've got all the answers, you know.
Yeah.
My husband was here earlier, though. Now he's doing the remodel.
Yeah. So what do you guys do? What brought you to the chamber?
My husband and I purchased a bar in 2018 that is Commerce City's oldest, I believe, bar.
Oh, wow.
So it's been an interesting first year and a half for sure.
Yeah. Were you guys able to get that paycheck loan?
We were. It doesn't help us immensely because a lot of our people are contracts, like our DJs or a karaoke host or this or that. So it didn't help us. I think that should be changed in the future, because when they first came out, they said it was going to. And then we had all those plans of okay, and then working with our employees, and then they came back and said no, and then cut it by a third of what we were hoping to get. So first time around, I know that there's got to be some tweaks to it, and I hope it gets tweaked back to how it was originally.
Well, it may be worth looking into one of those economic injury disaster loans. They're very low interest. There's 30-year repayment.
Are they getting used up as fast as the PPP? I mean, is it the same?
No, it's different. It's two separate loan programs. And so the PPP is going very quickly because it's essentially a grant, you know, when you really look at it. But the economic injury disaster fund was they just doubled it from 10 billion to 20 billion. As far as I have heard, they are not as under pressure on that portion. And you can take a loan for those things that PPP wouldn't cover. It wouldn't necessarily be forgivable, but helpful, absolutely.
Yeah.
Absolutely.
I just didn't know if I should go ahead and take the time to do the paperwork, because I don't mean to be glasses half full right now, but I feel like as soon as I get the paperwork done, they're going to say, oh, we're out of money. I'm like, wasted all that time.
Well, I can tell you that, you know, I don't think that, and I think the last round would show us they really don't want these programs to run out of money. But I would work with, and I believe the economic injury disaster loans, you work directly with the SBA. It's not through an individual bank. And so
that's what threw me when I got my PPP. I thought that we could do them at the same time. And they're like, I didn't understand that. So that's good to know now.
Yeah. I'll have, when they allow me back on airplanes again, I will have to come out to Commerce City and, you know, come have a drink.
The Hideaway Saloon, it's very nice and we have a lot of fun.
Oh, good.
Lynn, for the economic relief, those are really low interest rates as well right now.
Yeah, I believe it's 3.75%. So it may have even gone down with the cut in interest rates, but that is it's a very low interest loan, and it's payable over a much longer period of time.
Right. Okay. So that's right.
And with, you know, all of the, again, the ability to take the losses you're going to suffer this year and apply that to potentially income you had in 2019 or 2018 and get a refund back. That could even potentially help repay that loan, or, you know, just put more money in your pocket. And so there's a lot, you know, the deferral of the employer side of payroll taxes is also just going to be something nice for everybody that owns a business. You don't have to pay your side of the employer payroll taxes this year. You can defer that and then pay it back over the next 2 tax years. So in 2021 and 2022. So there's a lot buried in here. You know, I'm suggesting everyone get in touch with their CPA and just see, you know, get a better idea of where they might be towards the end of the year and you know, what else there is out there that can help. So, well, good. Well, I'm glad I got to meet you guys.
Thank you so much.
Thank
Yeah,
you for your time, Lynn. Thanks for doing this for us.
of course. I'll talk to you soon, Sandra. And it was nice to meet everybody. And if I can
you.
ever help in the future, let me know.
Talk to you soon.
Thank you
Yes.
so much.
Thanks.
Thank you, Lynn.
Thank
Thank you, Lynn, for
you.
everything. Anyone else have anything else that you'd want to ask Lynn before we let her go?
Well, thank you, June, for organizing it.
Mhm.
Well, I wish all of our businesses the best. You know, that's what the chamber is here for, is to help all the businesses here in Commerce City. And Lynn, when you come to Colorado, come stop by and we'll take you on a tour.
Love
Even
it.
show you our Historical Society Museum, just telling you of the rich history that we have here.